Hey everyone, ever wondered how a brilliant idea for a new company actually gets the money to get off the ground? Or how huge corporations build new factories and hire thousands of people? Well, it all comes down to two powerful tools that are basically the engine of our entire economy: stocks and bonds. Let's dive in and see how they really work.
I mean, think about it. It seems like a massive leap, doesn't it? You put a little money away in your savings, and somehow that helps create jobs or fund a new technology clear across the country. How does that connection actually happen? It's not magic, I promise. It's all thanks to the powerful machinery of what we call the capital market. And today, we're going to pull back the curtain and see exactly how it's done.
So here's our game plan for today. First, we'll look at the market itself, the growth engine. Then we'll explore the two main paths companies can take to get cash. One is basically a loan, and the other is more like a partnership. After that, we'll break down what you get in return for each. And finally, we'll connect all the dots to see the big picture, how this all fuels real economic growth for everybody.
Okay, first up, let's talk about the engine room, the capital market. Specifically, we're looking at what's called the primary market. Just think of this as the very first moment money changes hands. It's really just a meeting place, a system where savers, people like you and me with some cash, can connect directly with companies who need that cash to build, to invent, and to grow.
At its heart, the transaction is incredibly simple. Savers, well, they provide the cash, and in return, the company gives them a formal, legally binding promise. This critical step, the act of creating that promise and selling it for the first time, is called an issuance. It's the birth moment where a company's need for fuel gets turned into something you can actually buy. But what kind of promise are we talking about here? It turns out there are two main flavors.
Let's start with the first path, which is probably the one that feels most familiar to all of us. A company can just borrow the money. Yep, they take out a loan. It's the same idea as getting a loan for a car or a house, just on a, much, much bigger scale.
And that giant loan is made official through a special legal document called a bond. Now, in Hebrew, the term is igeret chov, which is pretty cool because it literally translates to a debt certificate. And that's exactly what a bond is. It's a formal certificate that proves a company owes you money.
So really, the absolute simplest way to think about a bond is that it's just a very official IOU from a company. It's them putting it in writing saying, hey, you gave us money, and here is our legally binding promise that we are going to pay you back. It's a very clear, very straightforward deal.
And that promise, that IOU, is incredibly specific. The bond spells out three key things, crystal clear. First, the company promises to return the original loan amount, which is called the principal. Second, they promise to make extra payments for the privilege of using your money. We call that interest. And third, they promise to do all of this on a fixed, pre-agreed schedule. Everything is known right from day one. It's predictable.
All right, let's pivot to the second path, because this one sets up a totally different kind of relationship. Instead of just borrowing money, a company can look at savers and say, hey, don't just lend to us, why don't you join us? Become a partner in our future.
This is done by issuing something called a stock, or menaya in Hebrew. Now, a stock is not an IOU. It's a certificate of ownership. It's actual proof that you own a tiny little piece of the company itself. And this, right here, is the fundamental difference. It's huge. With a bond, you're just a lender on the sidelines. But with a stock, you become a part owner. You're on the team. Your fortunes are now directly tied to the success or, the failure of that business. You're in it together.
So what does being an owner actually look like? Well, let's follow the journey, which you can almost see play out on a stock market graph. It all starts with the IPO, the initial public offering. That's the big launch day when the company first sells pieces of itself to the public. From then on, as an owner, you get regular updates, like earnings reports, where the company literally tells you how business is going. And if things go well, you might get a dividend announcement. That's the company deciding to share some of the profits directly with you, its owners.
Okay, so this brings us to the really big question, right? If you were the saver putting up the cash, what's in it for you? What do you get back? Well, as we've seen, it's two very different kinds of promises, and that means two very different kinds of payoffs. This lays it all out side by side. With a bond, remember, you're the lender, so your reward is interest, those fixed, predictable payments the company has to make for using your money. But with a stock, you're an owner, so your potential reward is a dividend, an actual slice of the company's profits. See the difference? One is a fixed fee for a loan, the other is a share of the success.
Honestly, just let this one sentence sink in, because it perfectly captures the entire difference from the saver's point of view.
Stockholders, who are the owners, are entitled to dividends. Bondholders, who are the lenders, are entitled to interest. Simple as that.
Okay, so we've got the mechanics down for a single company and a single saver. Now it's time to zoom out. Let's see how millions and millions of these transactions, all happening at once, actually scale up to power the entire economy.
And this is the absolutely crucial next step in the chain. A company doesn't raise all this money just to let it sit in a bank account collecting dust. No way. They raised it for a reason, to invest it, to build that new factory we talked about, to research a game-changing new product, to hire more people and expand. And this kicks off this beautiful, virtuous cycle of growth. Step 1. Companies raise capital from savers like us. Step 2. They take that capital and they invest it, hiring more employees, buying new equipment, expanding their operations. And step 3. All that business investment creates more jobs, more innovation, and more value, which drives the whole economy forward.
And that's exactly why this stuff matters so much. The better we are at this, the more efficiently we can connect the people with savings to the companies that have great ideas, the faster and stronger our economy will grow. A healthy capital market isn't just about Wall Street. It's about building a more prosperous future for everyone.
So, we've come full circle. We've seen how your savings can become the fuel for the economy through two totally different paths. You've got the loan, the bond, which offers predictable certainty, and you have the partnership, the stock, which offers shared risk and the potential for a much bigger reward. Each one plays a vital role in this massive economic engine. So the question to leave you with is, now that you see how it works, which path makes more sense to you?